Hi, this is Michael Jones, Chairman and Chief Executive Officer of Caravel Concepts. Welcome to Market Insights, our periodic commentary on economic and market events. Let's get started. The past week, pretty much so almost every day since Thanksgiving, has been dominated by news about the Omicron variant of COVID. Markets have been going down and down on fears that this is a much more contagious variant, and the increasing realization that Omicron is already everywhere around the globe. And then there's resurgence of the market when people start realizing that maybe this virus variant, although more contagious, has followed the typical virus evolutionary path and has become less deadly. An example of that, the 1918 flu pandemic virus, we now call the common cold. So on days when the market is worried about how quickly this variant has spread, we go down. When we get reassured that maybe it's not as deadly as prior variants, like today, the market soars back up. This volatility, we're going to look past because we're not sure what the ultimate conclusions will be on Omicron, but what we are pretty confident of is that global leaders seem pretty determined not to react to this new variant with renewed lockdowns. And without renewed lockdowns, the economic damage of this variant will probably be much lower, irrespective of how virulent it is. So let's talk about a market consequence that's been happening under the surface that not many people have been talking about because of the focus on this virus and the latest variant. And what that is some of what could be early warning signs about the consequences of the Federal Reserve shutting down their printing press. Because looking through all this headlines on COVID, Chairman Powell, who has now been reappointed at the Fed, his congressional testimony has made it pretty clear that the Fed is concerned that inflation may not prove temporary, and that their discussions are all about how quickly they will be shutting down the printing press that the Fed has been running since September of 2019. Just to remind everyone, since September of 2019, before we even heard of COVID, the Fed has been injecting more than $100 billion of fresh liquidity in financial markets every single month. And what financial markets have been riding high on since March of 2020 at the height of the COVID panic, what the markets have been recovering based upon is that earnings growth has been much better than people had expected at the height of that panic, and that steady push of Federal Reserve injecting more and more money into financial markets. That's a fantastic tailwind that allows asset prices to rise. All right, so now the Fed chairman is starting to talk about how quickly are we going to shut that process down, and maybe even early next year start running the money printing press in reverse. And the way when the Fed does that, that means that they are raising interest rates. They raise interest rates by pulling money out of the market instead of printing it and pushing it in. Now, we see some early signs that the market may not be entirely happy with the process of the Federal Reserve shutting down that printing press. Where do we see it? Well, first of all, if you read our piece about inflation, you saw that we expected oil prices to come down because U.S. oil production is ramping up, and eventually that supply will hit the markets and bring prices down. We did not expect oil prices to just suddenly collapse by 20%, which is what they've done in recent weeks. All right, and unlike the headline, the S&P and the Dow that have fallen and then bounced back, oil prices have fallen and pretty much so stayed down. All right, that's warning sign number one. Even though we expected it to happen, we expected it to be gradual, not this sudden plunge. The other thing that's happened in recent weeks is some of the most speculative stocks in the market, the technology stocks that are trading at 10 times sales, 20 times sales, these unbelievably speculative valuations, they've fallen about 25%, far more than the larger market. And as a matter of fact, they've given up all of their gains year to date. Add to that small cap stocks. That's another fairly aggressive, speculative place where people like to put their money when times are good and liquidity looks great. Well, small cap stocks have also plunged about 15 or 20% in recent weeks, and they've also given up pretty much so all of their gains year to date. Those are two warning signs when the most aggressive parts of the market are falling and don't bounce to the same degree that the larger market does. That gets our attention. And it particularly gets our attention when we look over to the bond market. Now, people think of the bond market because it's boring and that interest rates are just interest rates. But actually there are two very different types of interest rates. There's short-term interest rates. Those are controlled by the Federal Reserve. And based upon what Chairman Powell is saying, short-term interest rates are rising, anticipating that the Federal Reserve is going to be raising interest rates next year. Long-term rates, on the other hand, are falling. And that is a little bit of a warning sign that bond investors, the long interest rates are not directly set by the Federal Reserve. They're more at what investors are thinking about the future of the economy and financial markets and a safe harbor in case stock prices might get into a little bit of a stormy sea. All right? So when long rates go down as short rates go up, that's another one of those little cautionary flags that has us focused on what might it mean for financial markets as we move into 2022. And when we think about what it may mean, what we'll boil all this down to say that it looks like markets are starting to worry that the Fed is going to be caught in a little bit of a vice, that inflation will remain higher than the Fed is comfortable with. And when you say, well, why would that be if oil prices are coming down? And it's not just oil prices that are going to come down. We also expect car prices to come down. We think home prices will stop going up quite so fast. There's a lot of stuff that we expect inflation to moderate on. But 70% of the US economy is not stuff, it's services. And service inflation is determined by wage costs, because services are delivered by people and you have to pay the people to deliver those services. And there doesn't seem to be any slowing down in our red hot labor market, and labor costs are rising really, really fast. And so what the market seems to be anticipating or worrying about is that the Fed will see stuff prices come down, but it won't matter because 70% of the economy in services, those inflation rates are going to continue to be pushed upward by wage cost. And the Fed is going to have to keep tightening. They're not just going to have to shut down their printing press, but they're going to have to pull money out of the market and raise interest rates faster than the economy will be comfortable with. Or maybe not so much the economy, but maybe financial markets will be comfortable with. Because remember, part of this big surge in financial markets has been the economy's done better than we thought, earnings have been better than we thought. But another big part of it has been all that money the Fed has been printing and pushing into financial markets. If the Fed not only has to stop printing new money, but has to start pulling money back out because of inflationary pressures, because of those wage costs, then markets, the most speculative parts of the market, seem to be concerned about that. And that may have consequences beyond just people who are speculating on Netflix and Tesla. Because if we go back to 2000, the last time we had a set of circumstances that may be similar to this, where the economy was still doing good and wage inflation was going up, which was forcing the Fed to pull the money they'd printed back out of financial markets. Well, what happened is the first thing that happened was the super speculative pets.com and AOL.com, they went down. But then a few months later, as the Fed kept running that printing press in reverse, pulling money out of financial markets, ultimately the Microsofts and the Intels and eventually the Procter & Gamble's and the solid companies that were still continuing to make tons of money, they started coming down too. And the reason is what had pushed them up so high, the printed money, was being taken away, and that pulled it back. They pulled stock prices back down, even though the economy was continuing to do relatively well. That looks suspiciously familiar. That scenario from 2000, that looks suspiciously familiar as we look at some of these speculative stocks starting to really have real trouble in the marketplace. And we're going to keep an eye on it because we can certainly see the conditions that would force the Fed to keep stop printing money faster than is currently anticipated, and maybe raise rates faster than is currently anticipated. And as we've said very consistently since March of 2020, money printing is going to cause stocks to go up. And the first time we're going to have to worry is when that money printing stops. Well, it looks like we are getting to that chapter of the book, and investors need to be ready for what that next chapter may bring. Thanks for joining us for Market Insights. We hope you found it informative. If you did, we hope you can like the video and share it with your friends. If you want to see our other research, you can look for it on caravelconcepts.com. Thanks.